For Morningstar, I'm Jeremy Glazer. The U.S. stock market and global stock markets continue to be incredibly volatile as issues in China are under the microscope. I'm here with Bob Johnson. He's our Director of Economic Analysis for why China matters, why it doesn't, who are some of the winners and losers, and if the market is overreacting. Bob, thanks for joining me today.
It's good to be here today.
So let's start with why China matters. Why does the market paying attention to the apparent slowdown in growth in China? What are some of the big places where China is a huge factor?
Sure. Well, China is a big country. I mean, its GDP puts it kind of second in the world, only behind the U.S. by country. And you throw in the European Union, if you counted them all as one block, would be ahead of China. But it is a very big country that's got an influence on a lot of things. One thing to keep in mind, though, with China is that they aren't necessarily the be-all and end-all of the world economy either. I mean, they are somewhat an insular country, and so it's not going to have necessarily all the dramatic effects that people seem to be attributing to it.
So let's look at commodities. That is one place where they probably will have a big impact.
Absolutely. I mean, a lot of the industrial commodities, copper and many others, or coal or iron ore, China may absorb as much as 50% of some commodity categories. So as they go, so go those commodities. So that's got a very, very big impact on anybody that sells commodities into China. It also has the knock-on effect, if you will, that tends to touch more on, say, Germany and the U.S. economy, is that to mine and produce and ship all of those commodities takes a lot of industrial equipment, which the U.S. and Germany happen to be very good at. So companies that produce those types of industrial goods will certainly have their share of problems. Also, I might add that China has been absorbed a lot of cell phone materials over the last few years. Some of it for export back out again. As Apple's grown, so is a lot of the imports of raw semiconductors into China. And China was one of the fastest growing users of cell phones and smartphones over the last several years. So it's been a major source of growth for a lot of tech companies. And I think that is probably slowing up just a little bit, or at least market shares are changing pretty drastically there. So certainly we're having an impact there. And I'd say those are probably the big three impacts that are real, but in a lot of other things, they're not as important as you might guess.
So looking at the U.S. economy, where is China not having a big impact? Are we really seeing any weakness in the U.S. because of what's happening there?
Yeah. Well, I think one has to really step back there, and 0.9% of the U.S. GDP is dependent on China. And that's really a very small number. Canada and Mexico would be far bigger than that. So it's not terribly important. And a lot of that's not terribly economically sensitive in the short run. It's jetliners that are under contract under 10-year deals. And, we may get different shipments every month, but it's not because of changes in the economy. It's because of changes in Boeing's production schedule. So I'm not terribly worried about that. Even in the commodities world, we're probably most exposed in some of the gasoline and oil-related stuff, and even there, those are necessities. That maybe growth won't be as fast as people thought, but it's not like they're going to use less energy than they used before. So I'm not expecting a big impact on the U.S.
But one of the things we learned in the financial crisis was that there can be this interconnectedness, there can be these linkages that could happen if there was, say, a financial crisis. It could bleed over. Is that something that you're at all concerned about?
A very good point. And that's probably what's got me worried the most. And it's unfortunately, it's usually because it's something you can't see or you don't think it's that big, and it turns out to surprise everyone. But I think certainly my biggest worry that is there's some corporation that's very related to commodities that has a little bit too much debt and brings down a big U.S. bank or a big European bank, or brings down some commodities fund, or brings down some investment manager that's got big lending amounts from a multinational bank. And that's probably my biggest worry of what could go wrong here. But I'm not as worried as maybe some are, because China is a very much insular economy. I mean, it isn't like every big multinational's got a huge lending operation in China. China controls a lot of the lending market over there, and it's not like there's a lot of exposure to big banks that's going to transmit itself around the world. So I'm a little bit less worried that way. Now, there are some things that, I mentioned it's not much of the U.S. economy, but it's more of some other economies. It's 6% of German exports. I'm sorry, 3% of German exports, 6% of Australia's, not exports, of their GDP. And so those numbers can be much more affected. So there are some things that we will see across the economy.
So there could be some contagion, but you think for the most part it's not something U.S.-based investors should be incredibly concerned about?
No, I think this situation in China will be relatively contained, especially relative to the U.S. I mean, the data just keeps coming out on the U.S. I mean, for the first time in probably 4 or 5 years, I'm actually tempted to raise my 2 to 2.5% GDP growth rate. The auto sales were tremendous this week, just really great numbers. The housing industry's kind of really picked up strength. The ADP data this week seemed to suggest that maybe employment is holding up better than we all thought. So the U.S. Appears to be doing very well, thank you.
But the U.S. economy and S&P 500 are two very different things. Could we see a big slowdown in earnings and a potential turmoil or weakness in the stock market because of that?
Absolutely, and here's the reason. We talked just a moment ago about China being less than 1% of U.S. GDP. Exports in general, even if it spreads to Brazil and you throw on a whole bunch of other countries that this could spread to, Australia or whatever, exports in terms of GDP is about 13% of U.S. GDP. But if you look at the S&P 500, and again, it's controversial depending on how you calculate it, but 25 to 40% of revenues are from overseas countries. So roughly twice as dependent on a revenue basis, and on growth probably more than that. And depending on how the accounting goes, it may be more or less of earnings. Nobody can really make a good guess at that. So it's exceptionally important. And you might ask, why that big difference? How can it be so much of the S&P 500 and so little of the U.S. economy? Well, a lot of those goods that are made by U.S. multinationals are manufactured in other countries. In fact, some of the stuff that we sell in China might be manufactured in China under a joint venture or whatever. So a lot of the situation in the S&P 500 comes because the goods are not manufactured in the U.S. We went through the whole period, 2010 through 2012, where the U.S. economy really grew a lot slower than anybody had hoped in terms of GDP, but S&P earnings went through the roof. Now, unfortunately, I think we're going through the other end of that, and it could affect S&P earnings.
So we might have an impact on earnings. There's some risk of contagion, but overall it seems like you have a pretty balanced view of what the impact of China is going to have. Do you think then the market is overreacting, that these big swings, this big volatility we've seen maybe is either misreading of what's happening in China, or is there more going on? Are people worried about the Fed?
I think there's a lot more going on, and I think China happened to be a convenient excuse for people to sell a little bit. I think we've all talked about valuations being a little stretched for some time. Certainly, none of us can really guess exactly when the Fed might be raising rates, but it's certainly highly likely that in the next 6 months that they raise rates, and then probably raise them even a couple of more times, especially with the strength that we're seeing in the U.S. economy. And higher interest rates are usually not terribly good for stock markets. And so I think there's a number, and you mentioned the earnings thing with corporate America being a little bit more dependent on overseas business, and you roll all that together, and we haven't had a sell-off in kind of 3-4 years of a 10% magnitude, so it's kind of time. And so I think all of those things combined made China a convenient scapegoat. And it was interesting. The biggest sell-off this week came on Monday when one of the purchasing managers' surveys came out on China, and it dipped below 50. Well, that just is one measure. There's been other PMI measures that have been below 50 for kind of 6 months running. So it's not exactly a surprise to anybody that's really tracked China closely. So I think that it seemed odd that the market was selling off on what I viewed as already well-known news on Monday, which leads to why I think that those other factors, a stretched valuation, the potential for a Fed rise, and earnings are every bit as important as China for the recent decline.
So there could be more volatility ahead, but it might not just be because of China.
Right, and especially as the Fed wavers on what they're going to do and what the employment report's going to be this week, will all have an impact.
Well, Bob, I certainly appreciate your take on this today.
Thank you.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.